All right, well, welcome everyone to our virtual event featuring our newest corporate partner sponsors, American Pacific Mortgage. For this event tonight, we're going to learn all about the tips and tricks that you need to be a first-time home buyer. My name is Josh Prue. I'm here from the Alumni Relations Office at UConn, and I'm thrilled to be your host tonight. Tonight, we're going to see partners from American Pacific, Jason Mata, joining us to talk a little bit about first-time home buyers. And this is the first of 4 that we're going to do here over the course of this calendar year. So we're excited to kick off this partnership with American Pacific Mortgage. And we hope you are going to enjoy the evening's presentation as well and enjoy this relationship that we have started here to support you, our Huskies out there, in all the things that you need to know about home buying. Before we get started tonight, a couple of quick things for you to help participate. We do have closed captioning available for you. So should you wish to utilize this service, go ahead, visit your Zoom toolbar and select the CC option and go ahead and activate those subtitles. They should pop up immediately at the bottom of your screen. And next, as we get into our discussion tonight, we are expecting some questions throughout. The chat is going to be open. The Q&A section is going to be open. So please familiarize yourself with the bottom toolbar that you have here on Zoom. When something pops up, please go ahead, throw that out there. Whatever you need to do, chat, Q&A, we'll be monitoring that. And Ken from APM is also going to be on there answering questions along the way. So shout out to Ken, and thanks to my colleague Sarah Lamazzo joining us tonight as well. Both of us will be available for any types of support we can lend you tonight to help maximize your experience. And we thank you very much for joining us tonight on this new endeavor we're embarking on. Last but not least, thanks to our partners at American Pacific. Jason, thank you for joining us. We're thrilled to be kicking this off with you guys. I know you and I have been talking for quite a few months now, figuring out the best way to roll this out, and we're thrilled to be finally at the finish line getting this started. So thanks for kicking us off tonight.
Awesome. Well, pleasure to do so.
All right.
All
I'll turn
right.
it over to you.
Awesome. All right. Well, thank you so much, Josh. It's great to be with our UConn alumni tonight, our Husky family. And this is our first workshop for 2025. Really excited to bring this content to you. This is a class that we'll be offering virtually 4 times a year. So once a quarter, we'll be able to offer this class. And we just want to provide value to our community here. And we're really teaching on what's going to be one of the biggest financial decisions you decide to make, which is home buying. And so we're appreciative that you've taken time out of your busy schedules on this Thursday evening to learn a little bit about home buying. Our runtime for tonight's class will take us up just to about the top of the hour. As Josh mentioned, we're going to weave in questions and try to make tonight's session a very interactive session. This is also being recorded, so you get a chance to look back at some of the recorded video and maybe pick up something that maybe you missed during tonight's class. We encourage you to take notes because we're going to provide a lot of great content to help you on that journey towards home ownership. Well, just a little bit about me. Again, my name is Jason Mata. I'll be your presenter this evening, and really thrilled to bring this content to you. What I do is I not only present this type of workshop material, but I also work one-on-one with our clients all across the country. So after tonight's class, you may be encouraged about the possibility of home ownership, and we hope you are. I'll look forward to getting connected with you for what we call is a consultation. That's a free service we provide to our local communities. So we'll help kind of teach you a little bit more about how to take that next step at the end of tonight's class. Well, it is a very interactive class, but we also are going to provide you a lot of great content. Here's kind of what we're going to talk about tonight. We're going to dive into the housing market, what's going on right now. We realize it's really cold, this part of the world here, and you know, the housing market may not be super hot right now, but certainly the housing market cycles. And so we're going to talk a little bit about what that means for us as home buyers. We'll also spend some time looking at the interest rate environment, what's going on with interest rates, and where do projections look like. We're going to walk through a budgeting exercise. You know, again, this is probably going to be one of the biggest purchases or decisions you decide to make. So let's kind of figure out what budgeting looks like for us. And then we're going to move from there into credit. I want to provide some tips and resources around credit, whether I'm trying to manage down debt or try to optimize my credit score. We're going to give you some great tools around that. We'll then outline some various loan programs that are available to you as first-time or even second or third-time buyers. And then from there, we're going to talk a little bit about how we save for home ownership. You know, when I think about home ownership for our buyers, there's usually 2 challenges to home ownership. It could be around credit, maybe because of my obligations or my credit score, but most often I find it's around saving for home ownership. So we're going to talk a little bit about that, as well as first-time homebuyer programs that are available in the state of Connecticut for you. And if you're joining us from other parts of the country, we can certainly talk really quickly or offline about some other first-time buyer programs that are available all across the country. And then we'll look at the buying process. So after tonight's class, you may say, hey, this is really intriguing for me, and I want to learn a little bit more about how I take those next steps. We're going to walk you through the workflow of owning a home, and then ultimately kind of like, how do I build a plan for myself and how we can be a partner for you in that journey. Well, let's start off tonight's class talking about, does buying make sense for me? And I think that's the question probably most of us need to kind of ask ourselves in tonight's class. And I think, when you compare renting versus owning a home, I don't think it's fair to say it's an apples to apples comparison, because there truly is a lot of wonderful benefits that come along with owning a home. So when we think about budgeting, right? So as a homeowner, I can really control and have a little bit more stability in my housing budget, because I'm not worrying about my landlord that possibly could increase rent every year when I renew my lease. So that's one thing we have to think about. Some of our buyers that are buying in today's market, where we're at elevated rate levels, which we'll talk more about tonight, but for clients that are buying in today's elevated rate market, there still are opportunities to refinance their homes down the road. So as rates start to normalize a little bit, while we might be paying maybe a higher premium in interest rate today, there might be opportunities in the next 2 or 3 years to refinance, to change affordability for an existing homeowner. And this is an asset that will probably be one of the largest assets you own. And as that home grows in value, we call that appreciation. And the difference between where your home value is at versus what your balance is, that's called home equity. And that's where it becomes one of the largest assets for most people across the country. This asset does also have the ability to really create generational wealth for families, right? And there's also some great tax benefits that come along with owning a home. Maybe you didn't know that interest can be potentially tax deductible for you. So that's something to consider in the equation for ourselves. And there can be potential tax deductibility benefits when it comes to energy efficient upgrades to our home. So I would encourage you, when you think about home ownership, whatever your timeline is for you, we want to factor in some of those really great benefits that come along with owning a home. And as we get started in tonight's class, I thought a great place to launch into our class would be to do a rent versus buying analysis. And essentially what we're going to do with that analysis is to compare, what does it look like if I continue to stay on my path of renting or paying room and board for my existing place, versus what could it look like if I decide to purchase a home. So I kind of switched screens on you just now. We went into our browser to a rent versus buying calculator. By the way, as a quick side note for our audience tonight, we're going to send out all of our presentation material to you tomorrow morning. So I know we're recording tonight's class, but our entire presentation will be out broadcast to you tomorrow morning as well too. But this calculator ultimately will help kind of pinpoint for us the opportunity of buying. And so I've kind of pre-filled in some of these sections just to keep us on track for our timeline tonight, but let's kind of walk through what this looks like. So if we were to look at a rental side of things, let's say we're paying rent of $2,500 a month. In that rental equation, we want to factor in renter's insurance, and we're going to make an assumption that my rent will increase 3% on an annualized basis. Okay, so that'll be kind of on our rental side of the equation. And then let's look at this next tab, which is the home purchase. We're going to make an assumption that I'm going to buy a $450,000 home. We're going to talk about loan programs in just a bit tonight, but ultimately the minimum down payment as a first-time buyer using a Fannie Mae or Freddie Mac conventional loan is 3% of the purchase price. So we want to kind of put that into our calculation. We factor in property taxes for my new home, what my homeowner's insurance might cost. And of course, homeowner's insurance comes up in the news quite a bit in different parts of the country. So that will vary in cost depending on where I want to purchase. We have maintenance costs in my home. So when I think about owning a home, I can't call my landlord anymore, right? I have to have maybe savings set aside to take care of those little unexpected expenses that come along with owning a home. And then we have loan information. So pretty basic stuff here, but we're going to have a 30-year fixed mortgage is our assumption. We're going to plug in average interest rates of 6.8%. And then we have this next section, which is origination charges. And ultimately what origination charges are, it's what a lender is going to charge you for your home financing. Now, one of our benefits added in our partnership with the Alumni Association is we actually discount our cost by $750 to create better affordability for you. So when you decide to take those next steps in homeownership with our team, we're going to discount our services by $750 to help make just lending a bit more affordable for you. And then this is discount points. And you might have heard about it, discount points, as you've been exploring home buying. But what discount points allow you to do as a home buyer is to pay additional expenses out of pocket in order to drive down that interest rate. We don't necessarily recommend paying discount points in today's market. And the reason for that is because most of our clients buying today in an elevated interest rate market are probably going to consider refinancing in the next couple years. Well, investments like discount points usually have about a 3 to 4 year break even mark. So quite honestly, it doesn't really make sense to make those investments into bringing down the interest rate. But all in all, a discount point essentially is 1% of your loan amount, which will essentially equate to about a 0.25% reduction in overall interest rate. And then we have other settlement services. Those are going to be things like attorney fees for our transaction. Those are going to be like government transfer charges. Things of that nature will fall under other settlement services. Last section would be other assumptions. In that section, we're going to assume that our home will go up in value as an appreciation rate of 4%. We assume that we're going to be in our home for, let's say, 7 years, and we'll compare that to renting for 7 years. We have the selling costs of our home. So in our projection here, we're going to say that we're going to sell this home at the end of 7 years. We have state and federal tax rate, and then we also have a savings rate. All right, so let's first of all look at the budget and a side-by-side comparison. So if we say, we're paying $2,500 a month in rent, compare that to owning a home, which would be a monthly payment estimated at $3,800 a month. Clearly, that's a pretty big jump up, right? That's a $1,300 outgoing increase. But I think where the opportunity lies for us is future buyers is, there's about an $87,000 buying opportunity in looking at owning a home at $450,000 in price versus continuing to rent at $2,500 a month. Because when I factor in the tax benefits of owning a home, plus the potential appreciation rates of my home, I can potentially generate $87,000 in wealth for myself over the 7 years. And I think that gets where prospective home buying gets a little bit lost. So when we consider home ownership, we want to bake in all those other great benefits that come along with owning a home. All right. So that's our rent versus buying calculator. I thought that'd be helpful to kind of walk our audience through that. We did get a question that came in the chat. I know Ken was kind of type that in for us, but let me just answer this on air, which is, what are the pros and cons for purchasing a multifamily home and renting out units and then using those profits to accumulate additional real estate? So that's going to be, something that would be obviously more an advanced thing for most first-time buyers purchasing a multi-unit, but it certainly can happen. Multi-unit properties will generally have a little bit more of an elevated down payment level. For a conventional loan, it's a minimum of 5% down. For an FHA loan, it's 3.5%. I think, that the conversation it's going to be more of a strategic look at things where does it make sense for me to take the risk of a higher priced multi-unit property, depending on what I can rent ultimately those units for, does that accomplish my goals? And those goals could be accumulation of equity. It could be break even. It could be cash flow in a multi-unit property. But I would encourage you, if that's something you're considering, let's talk more about that and kind of have a strategic conversation on what, multifamily home buying can look like. And we can spend some more time on that during our product section as well. Let's talk a little bit about the housing market, because ultimately the price of home will drive our purchasing power, right? And as interest rates maybe move up, our purchasing power could lessen. I mentioned earlier as we started tonight's class is that, kind of in the cycle of housing right now, we're in the winter months. So, especially in the Connecticut market, a little colder, right? So not everybody's running out and jumping in their cars to look at homes. So, seasonality plays a role in the housing market. So traditionally this time of year, it's a little bit slower, but I will say in most parts of the country, buyer demand is up. We haven't been quite able to kind of pinpoint why that buyer demand is elevated. It could be because of fear of where interest rates are going, changes in administration, could be changes in home market values across the country. There's a whole variety of different reasons it could be pointed towards, but ultimately buyer demand is up. Inventory is kind of where we still have a challenge in most parts of the country where there just isn't enough opportunities or resources for or solutions for buyers right now in terms of a home that they can take advantage of, right? So that's where the concern is, and I think it goes back to basic economics, right? So if we have limited supply, high demand, what ultimately happens with prices? Well, we look at the Connecticut market right now, a little bit of a downward push on prices. I think a lot of that probably is attributed to seasonality in the markets right now. So, as we kind of push this further out into the spring and summer buying months, which traditionally, April through August will be your heavier buying months, we probably will see that line flatten or possibly go up a little bit, depending on what happens with prices. Average day on market right now for homes in the Connecticut market is 51 days. So basically from, going on market to actually closing or having an offer is about 51 days. The buyer behavior will also be driven based upon what interest rates look like. And I think it's important to look at it from two different lenses, if you will. So I want to give you a snapshot of what's it look like over the last 20 years. And then what does it look like most recently in the last 12 months? Because, there's a different perspective or different look at each one of these interest rate levels. So today, the average interest rate is just below 7%. And you can see that kind of encapsulated here in our 12-month snapshot. It's been a wild roller coaster ride of interest rates. We're certainly not at the levels that we saw about 18 months ago, where interest rates touched on 8%, which you can see reflected here. But I think it's important to understand, how do we get here from an interest rate perspective? Well, we're all kind of feeling it right now. Cost of everything is a bit more expensive, right? Go to get gas in my car, go to the grocery store, the cost of whatever, milk, eggs, any produce is elevated. So we're in a high inflationary environment. Well, the Federal Reserve has tried to combat inflation by increasing interest rates. The inflation goal for the Federal Reserve is 2%. We're over the 2% mark still, but the Federal Reserve is trying to bring inflation down, at the same time watching what's going on in the labor markets. And so we've seen recent cuts in interest rates at the end of last year. The Federal Reserve is set to meet again in March. I don't think we're going to see a cut in March, but we're certainly watching that really carefully. When you hear in the news that the Federal Reserve is going to cut interest rates, that is going to have a direct correlation to the cost of credit card interest rates, auto financing, lines of credit, things of that nature. It will also have a ripple effect into mortgage interest rates, but it's not necessarily a one-to-one ratio type thing. Now, I want to just comment one other thing on interest rates. So if we look back in the 20-year chart here, a historical average of interest rates is about 5.5%, give or take, right? So when we look at today's interest rates, we're almost at the early 2000 levels. Of course, the pandemic, which is represented here, was the lowest interest rates have ever been, which is right around 2.5%. Certainly, interest rates will hopefully never go back to that place again, because obviously that was a catastrophic time for our world. But what happens in our market, normally we would see a rate at 5.5%. So I think, the question I get from clients is, well, when are we going to go back to 2.5% rates? Well, hopefully we don't go back, because that means something really bad has happened. And so I think as a normal level, we're looking at, 5.5%. I think the projection out for this year is we're probably going to still stay at elevated rates in the high sixes. Maybe we go down to 6.5%. We probably won't see any significant reduction. And what I mean by significant is maybe a 1% reduction rates, probably until 26, maybe into 27. All right, I see some questions coming in the chat. One is the question around down payments. We're going to cover that. We actually have a product conversation we're going to have as well. So stay tuned on that. We'll talk about that in just a few minutes, and I'll definitely get all those questions answered. Let me just make sure. I think we're good otherwise. Okay. All right, let's talk a little bit about how interest rates are made up. Because it's not a one-size-fits-all for interest rates. Interest rates are made up of a few different characteristics. One is credit score and eligibility, what type of product I'm going to select, how much do I need to finance, what does my down payment percentage look like. We talked briefly in our rent versus buying calculator discussion about discount points, where I can pay additional funds out of pocket to bring down my interest rate. So that could change what my interest rate makeup looks like. And then the term of my loan can also influence interest rate. So generally, most first-time buyers are going to elect a 30-year fixed mortgage. But if I shorten my term of my loan, that can generally lower the cost of my interest rate. At the end of the day, as we meet with our clients to do buyer consultations, we're going to figure out the right kind of path towards home ownership for you, and ultimately the right structure of your financing, basing that upon goals and objectives for your home ownership situation. So, but I think it's important to understand that, just because your coworker got a 6% rate doesn't necessarily mean that's the same rate you would have, because it really just changes for every client situation and ultimately what the market conditions look like. Well, one of the things that can influence interest rate is credit. And so what we like to do in this part of our workshop is to talk a little bit about credit and how to not only improve your credit, but really to have some awareness around what goes into our credit scores so we can optimize things when it comes to home buying. Well, I think it's important to understand that each product has a minimum credit score. So you can see those on screen here. We have the FHA product. And by the way, we'll learn all about these products in just a bit. We have the FHA product at 580, conventional loans at 620, and for the veterans product of the VA home loan at 620. And when we look at a credit report, major events that are on credit reports, like collections or foreclosures or short sales, those could have a bigger impact than, say, a late payment that we had on a credit card maybe a couple years ago. Events on your credit report in general in the most recent 12 to 24 months can have the biggest impact to my credit score. So I think that's important to understand. We're gonna understand kind of more about the weighting of credit scores, or different aspects of the credit score as we kind of move along in our credit section. We're gonna spend some time looking at credit utilization, which ultimately credit utilization is looking at your credit balances versus your credit limits. When I look at hundreds of credit reports throughout a week, that's probably the biggest area of opportunity for most clients is how can I bring down credit card debt in order to elevate my credit score. And then account closure is simply looking at if I decide to close out a credit card, when I do that, it can actually take away or deteriorate my credit score. It can potentially lower it because it changes how long or how seasoned my accounts are that are outstanding, but it also changes the number of credit limits that I have outstanding on my credit report. When we look at the credit report, these events that we've had that are maybe major events, this is how long they're going to stay with us on our credit report. So I think it's important to understand, if you do a hard inquiry for a credit report, it will stay on your credit report for 2 years, but the impact to your score will probably be more so in the recent 12 to 24 months from the date of the inquiry. Now, one of the things that we do a little bit different than most lenders, because we work so heavily with first-time buyers, is we only start with a soft credit score. And the reason why we do that is because all of our first-time buyers have various timelines of buying, right? So most first-time buyers aren't going to turn around and go buy a house this weekend, right? It's going to be a cycle, right? They're going to kind of explore options, and it may be something that we're building up towards. So when I meet with clients, it could be a 1-year timeline, it could be a 1-month timeline, but ultimately we want to create really great framework for the home buying opportunity for a client. And so the soft score allows us to be able to explore those options without impacting the credit score. So this is the weighting of a credit score model. Now, I think it's important to understand, and let me just kind of backtrack a little bit so we're all on the same page. There are 3 different credit agencies, which I'm sure you're all aware of. So it's TransUnion, Experian, and then there's Equifax, right? So each one of them have different risk models and how they assess their scores, and that's why you see different scores on your credit bureaus. Now, within that, we also have different risk models. So there's a credit card score, there's an auto financing model, and then there's also the mortgage model. So if you're applying for home financing, as you can imagine, you're going to use the mortgage model. Most of us that are using monitoring tools like Credit Karma, for example, that's going to be a credit card model. So oftentimes when I'm working with clients across the country, they'll say, hey, Jason, Credit Karma says I'm at 790. And then maybe we pull the credit score because it's the mortgage model and it shows up as 760. Still great credit scores, but that's where we'll see a little bit of variance. So let's dive in and kind of take a look at the weighting of a credit score. So the first component, and it's 15% of the weighting, is the length of credit. I kind of touched on this in the account closure section, which is, if you close out an account, you strip away all the history you've had on a particular account, which could affect your length of credit. So the longer my credit profile shows out there, the stronger my credit score could be. 20% is going to be how much new credit am I trying to get access to? Am I applying for a bunch of different accounts, opening those accounts? That's going to have an impact to my score of 20%. And then this is the area of opportunity here, how much I owe as it relates to revolving debts. So simply put, if I look at my credit cards and I have, let's say, $5,000 in credit card balances, my credit limits are at $10,000. Well, that means I'm at 50% utilization of credit. The rule of thumb to optimize credit scores to get those credit balances down to 10%, or in this scenario that I just shared with you, $1,000, right? Now, you may have just booked that awesome trip to Cabo that you're going to do during the spring, and that's great. And now maybe your credit card balances are a little higher, right? Maybe they're 80% utilization because I have now $8,000 in balances. What I would encourage that client to do is let's try to whittle that debt down to get at least to 50% utilization. Once I got to that level, then we have to work towards 30% utilization. And once I've gotten to a place where I feel pretty good, let's get to 10% utilization. So if you're trying to get over that 800 credit score, that is what's going to take to get to that 10% utilization. Let me give you a quick tip in how to manage credit card debt. So when you look at one of your credit card statements, if you have some time this evening or tomorrow night, take a look at the 2 dates. Now, we're all familiarized with the due date, right? Because that's when we have to pay our credit card debt. Another date that's most important is called the statement date. And the statement date is the date at which the credit card issuer sends out all your information to the 3 credit agencies. They're going to send out how you paid your bill, what the credit limit looks like, what the minimum payment is, all that fun stuff. If you can create the habit of paying down that credit card or paying it off before the end of that statement date, what's going to happen is you're going to have a much lower balance. It's going to report out to the agencies. And in doing so, help improve your credit score. And so oftentimes when I'm meeting with clients, they may have had higher credit balances than what they expected. But once they are able to show that they've dropped that balance down, then maybe their credit score goes up slightly higher. In getting that increased credit score, maybe their interest rate looks better on their financing, potentially the mortgage insurance, or even the product that they get looks a little bit better. And then finally, the last component, which is 35%, the biggest chunk of the weighting for the credit score, is payment history. How have I paid my bills? And ultimately, that's really taken a pretty good look at the last 12 to 24 months. Delinquencies are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The more severe I'm at on that spectrum of lates, the bigger impact I'm going to have on my credit score. So if I had a late payment back in October of 21 on my student loan because it came out of deferment, I totally forgot, and I missed the payment, that 30-day late won't be as impactful today as it might have been on my credit score in December of 21, right? So as I get further away from that date of late last payment, then I'm going to have hopefully some organic improvement in my credit score. Before we touch on student loans, I just want to bring up one quick thing that I forgot to hit on earlier in the credit section, which is how we look at the credit scores. So each credit agency has a credit score. So if I have my highest score at 760, let's say my middle score is 740, and then my lowest score is 720, right? The middle score that we look at from a lending perspective is the 740. So that's what I'll use to evaluate my product offering, my interest rate, mortgage insurance, all of that stuff. Now, if I apply with my partner, and my partner's 700, high score, 680 mid score, lowest score 660. Well, we look at the lowest credit score between both borrowers, the lowest middle score, I should say. So in that scenario, we would use my partner's score, which is 680. So that's important to kind of take away, because as we build home buying plans for clients, we're going to figure out the right way to structure your financing, because maybe we need to apply in maybe just one name in order to maximize qualifying for a buyer. But those are certainly conversations we can have during a consultation. Well, as part of that meeting we have with clients, we always talk about, well, not always, but there's often times we're talking about student loans, because student loans, they will come up in the conversation if we do carry any student loan debt. Now, all federal student loan debt, for the most part, is in forbearance right now because of pending litigation over the forgiveness of student loan debt. I don't think we're going to have any resolution on that until probably September or October. Where that poses a little bit of a challenge right now in today's lending environment is that, for the most part, most of the student loan servicers are not putting an accurate payment on credit bureaus when it comes to us evaluating that payment for overall expenses for a buyer. Now, if you've entered an income-based repayment plan, let's say you have $75,000 in debt and you have a $250 income-based repayment amount, more than likely on a federal student loan, unless you're actively repaying, that payment does not show up on the credit report. And so where that poses a little bit of a challenge in lending is that because they're in forbearance, by default, we have to either count 0.5% of the balances as the minimum payment, or the total of 1% of the balances as the monthly payment on a conventional loan. And so, you know, anytime we're in a status of forbearance or deferment, really we're going to have to use by default those percentages for monthly payments. Everybody's situation is a little bit different. I wouldn't say every student loan servicing company is putting a forbearance or a zero payment on all credit bureaus, but it does pose a little bit of a challenge. I think the takeaway I would say for our class today is that just to be aware that even though you're in forbearance, when we qualify for finance, we're going to have to kind of take a look at what that looks like in in each buyer's situation. All right, I'm gonna take a quick pause before we jump into loan programs. I know we've already had some questions on loan programs, but I just want to kind of pass it back to the audience, see if we have any questions before we dive into loan programs. Okay. And I've seen some questions in the chat about this slideshow. So yes, we'll be sharing back out the slideshow with everyone tomorrow morning, I should say. And then we're also recording tonight's class as well too. All right, let's talk a little bit about loan programs, and we're going to spotlight 5 of the main programs when it comes to resources for financing. And so I want to kind of give you a high-level look at each one of the programs. We've had some questions that kind of correlate to some of these topics here. So let's first of all talk about the conventional loan product. When we think about a conventional loan, that's a Fannie Mae, Freddie Mac loan. Fannie Mae and Freddie Mac occupy about 60 to 70% of the origination space in lending. And as a first-time buyer, the minimum down payment for a conventional loan is 3% for a single unit property. So single family home, condo, townhouse, even a manufactured home, 3% minimum down payment with a minimum credit score of 620. Now, every year, right around October, November, Fannie Mae and Freddie Mac set the conforming loan limits across the country, which this year is 806,500. That essentially allows us as lenders to lend up to an amount financed of 806,500 with a minimum down payment of 3%. Now, if you're going to purchase and you're like in a high cost of living market, let's say you're in the New York market, or maybe you're in Virginia, there are certain parts across the country that are called high balance loan areas or high cost of living areas that we can stretch that loan amount with Fannie Mae and Freddie Mac up to as high as $1.2 million. But it does elevate the minimum down payment from 3% to 5%. Now, I had some questions in the chat about multi-units, so let me just explain to you the difference in the conventional space. So on a conventional loan, the minimum down payment, if you're purchasing a 2-unit, 3-unit, or a 4-unit property, is 5%. And so if you're considering that as your first option as a buyer, then you would have a slightly elevated down payment. Now, as you buy a 2 or 3 or 4-unit property, this minimum loan amount, or maximum loan amount, I should say, that will increase incrementally. The next product is an FHA loan. Now, the FHA loan also allows for multi-unit property purchases, but primarily most clients are going to use as a 1-unit purchase. It's a 3.5% down payment, regardless if you buy a 1-unit property or even a 2 or 3 or even a 4-unit property. The minimum credit score is a 580 on an FHA product. And then the loan amount for FHA is set depending on what county I'm going to purchase in. So maximum loan amount, most counties in the Connecticut market are 763,600, but it really just depends on what area of the country you're going to utilize the FHA product. As you can see, the credit score has a lower minimum than we would have on the conventional loan. A lot more leniency from an overall underwriting guidelines perspective. When I think about first-time buyer programs for our clients across the country, they're going to probably be centered in either the conventional loan or the FHA space. Next loan is going to be a jumbo loan, not really super common for first-time buyers, but it essentially allows a little more funding power beyond what I can provide under Fannie Mae or Freddie Mac guidelines. But it does come with it a higher down payment amount, which is usually 10 to 15% of the sales price, usually higher or more elevated credit score requirements. And there's also additional asset requirements. We call those reserves. So those can, make qualifying for the jumbo product maybe a little bit more challenging, but like I said, not usually typical for first-time buyers. And then the next product is the VA home loan. So for our veterans that have eligibility under the VA home loan product, they can purchase a home with as little as 0 down as a veteran. It has a lot more flexibility from an underwriting guidelines perspective. So when we look at things like we call debt to income ratio, expenses versus income, a lot more leniency for the veteran to encourage home ownership, lower credit score minimums at 620, and there really is no maximum loan amount for the VA home loan product. Next product is the USDA product, stands for the United States Department of Agriculture. It's encouraging homeownership in rural parts of the country. There's two major qualifiers with the USDA product. It looks at the household income. It also looks at the location of the property. Minimum credit score of 620. The big draw here with USDA is a 0 down payment option. In most parts of the country, it goes up to the conforming loan limit. And with that product, it may be a little bit more restrictive in terms of expenses versus income than what we might see in the FHA or conventional product. But for buyers that are really looking in those rural markets, it can be a very enticing product. So that's a quick look at loan programs. And as we take a little closer look at loan options, I want to explain to you what PMI looks like. We get a lot of questions about what is PMI. Well, first of all, PMI stands for private mortgage insurance. In this exercise we're going to go through, there's PMI, which is private mortgage insurance on a conventional loan. There's also government insured or MIP on an FHA loan. And so let me kind of explain to you what mortgage insurance essentially does. It basically insures the lender against a buyer's default. So if someone had a challenge as a buyer and was unable to afford their home and there's a default, the lender would be insured against that default because there's mortgage insurance in place. On a conventional loan, when I put less than 20% down, I do have to take on mortgage insurance. And mortgage insurance is not a one-size-fits-all type of thing. It's based upon down payment, what my credit score looks like, and what my loan amount or amount finance looks like. So the higher my down payment is, the higher my credit score, theoretically, the lesser my PMI cost will be. Now, on a conventional loan, once I reach 2 years in my original loan and achieve either 20 to 22% equity, I can apply to have the mortgage insurance canceled with my servicer. Here's an example of what PMI looks like on a conventional loan. So we have a $450,000 amount financed. We have a client with a 740 credit score, putting down 3%. Mortgage insurance would be about $183 a month. Now, if you've already started some of your home search on Zillow or maybe even Redfin, you can use our calculator functions there. But what I've found in working with clients is their PMI calculators are super high. So probably 2 or 3 times the amount you're seeing here. So I think it's important to take away here is that, mortgage insurance will decrease the higher I can get my credit score and the more elevated my down payment is. FHA mortgage insurance looks a little bit different because there's 2 forms of mortgage insurance. There's monthly mortgage insurance, which is calculated at 0.55% of my loan amount. And then there's upfront mortgage insurance, which is 1.75% of my total loan amount. And so it's it's a fixed rate premium on an FHA loan. Now, with FHA mortgage insurance, there's no cancellation option. So the only way I can exit that FHA mortgage insurance if I was to simply refinance out of my FHA loan into more of a conventional product. Now, if we look at that same scenario of the 450 loan amount, we overlay the FHA mortgage insurance. Now we're looking at upfront mortgage insurance to be added into my amount financed of $12,250. Plus, I have monthly mortgage insurance at $206 per month. So the expenses are significantly higher on the FHA product. But I think as we kind of do the side-by-side comparison, I think it's important to understand that with an FHA loan, it will add more leniency in the guidelines. So if I have a lower credit score, or maybe I've had some past challenges on my credit, FHA might be a solution that can work better for a client than, say, a conventional loan. Because every client that is looking at a conventional loan may not necessarily qualify, but FHA can still be a great entry point to homeownership. I would not look at the FHA loan as the long-term solution for clients. It allows us to get access to homeownership by using FHA. And then as credit improves, maybe our income situation changes, then I would really encourage our clients to try to move from FHA to maybe a conventional product. All right, let's talk a little bit about income. And I want to kind of dispel some myths around, what does my income or employment need to look like to be able to start that path towards home ownership. I first want to provide you with some documentation of what you would typically need. So if you're thinking after tonight's class, hey, I'd love to put together a home buying plan and figure out some goals and objectives for home ownership, here are some of the things that I would need, which would be typically like the last couple years of taxes, couple years of W-2s, bank statements, and then probably the last 30 to 60 days of pay stubs. So that's generally the documentation that we'll have to be able to get together. Now, let's talk a little bit about employment, because I think there's, like I said, some myths, if you will, around employment. So there is a 2-year rule in place for qualifying for financing, which essentially means that as a lender, I have to verify 2 years of employment and/or educational history. So here's an example for you. So if I graduated from UConn with an accounting degree in the fall of 24, I just started my new job January 1. Even though I just started my job, I can still potentially qualify for financing because I have, let's say, 4 years of undergrad at UConn, and then I just started my job, so now I have a source of income. That would fulfill the 2-year requirement. Even in a situation where, let's say, I've been on my job for a year, I have a new job opportunity, I have an offer letter in hand for me to start a new job March 1st, I can use that new offer letter to qualify for a mortgage. Now, where it gets a little bit more challenging on the 2-year rule is that if I have dual employment, so I'm working at one employer for 30 hours a week, maybe another one for 20 hours, if I want both sources of income to be considered, then I have to demonstrate that I've been on both jobs simultaneously for the last 2 years. All right. And if I have, let's say, a full-time job, but maybe I drive for Uber or Lyft on the side and I make up some income on the weekends, in order for me to include that Lyft or Uber income, then I have to demonstrate that I've been doing both my full-time job and my side job simultaneously for the last 2 years. If I'm a 1099 independent contractor, I've opened my own business. As a lender, we have to verify that you've had at least 2 years of tax filings in order to count that income. And usually for our self-employed clients, we're going to average the last 2 years of net income to determine what income can be used for qualifying. All right. So that's a little bit of a look at what income could be when you consider qualifying for a home mortgage. Last thing I want to share with you is if you have a partner or someone in your household that's contributing to your household expenses, if you're going to have their income included into the financing scenario, then we also have to include them on the application. So just because they're contributing to our household budget doesn't necessarily mean that that income can be used. All right. So one of the calculations we use in determining eligibility for a buyer is a simple calculation. It's called debt to income ratio. It takes a look at my existing expenses like my credit card debts, personal loans, auto loans, as well as my new mortgage or my housing expense versus my total pre-tax income. So we're trying to evaluate what that looks like as a percentage expenses to income. So here's kind of what that looks like. So if we look at this calculation here, we're taking in consideration principal and interest of my new home mortgage, the property taxes of my house, my homeowner's insurance. If I'm putting less than 20% down, private mortgage insurance. If I'm buying in a community that has a HOA or homeowners association dues, $2,500 a month in this scenario. And if I have $500 in other debts, that means my existing expenses are at $3,000. Now, if my income is $8,500 a month, that means my debt to income ratio is essentially 35.3%. Now, as it goes in lending, we can lend to a client anywhere between 45 to upwards of 50% debt to income ratio, depending on credit score. We've kind of shared with you kind of different levels of debt to income ratio on the screen here. The question I get often is, where should my debt to income ratio be? It varies for every client that I work with during these consultations, but I would say kind of the comfort zone for most clients is somewhere around 33 to 36% debt to income ratio. But again, qualifying allows us to go as high as 45 to 50%. We see that those higher levels generally in higher cost of living markets, or in situations where maybe a buyer can't prove all of their income that is part of their household, but the guidelines will allow those higher limits. I think the most important in this section of our class is to understand is that, we're really passionate about creating affordable plans for clients and sustainable plans, because those are two big goals in homeownership: affordability, sustainability. Essentially, the debt to income ratio is just going to be a measurement that we can use for qualifying. But again, I think, for most clients, I see kind of the sweet spot being around that 33 to 36% level. All right, last thing we want to talk about before we go into the buying process and assistance programs is to talk a little bit about saving for down payment. As I mentioned, as we started tonight's class, that's probably the second challenge beyond credit for some of our future first-time home buyers. So I wanted to explain to you kind of the documentation that we generally look to validate to see what you have saved. And then I want to give you a little bit of a savings plan for tonight's class. So let's talk about the documentation. So usually in financing, we have to verify the last 60 days worth of asset statements, checking and savings accounts. Cash deposits cannot work unless they've been seasoned at least 60 days in the bank accounts. Retirement accounts can be used, 401ks, 403bs, those are all totally allowed. I would encourage you to check with your administrator for your plans or your financial advisor before accessing those accounts, as well as brokerage accounts. Gift funds can be allowed too. That's where a family member is essentially contributing towards your out-of-pocket expense to purchase a home. There is no seasoning requirements when it comes to gift funds. As long as it's an immediate family member, they can absolutely contribute towards the home purchase. Now, for first-time home buyers, savings can be a challenge. And so I want to give you a quick tip on how to maybe start your savings plan today. So when I meet with clients and maybe we determine that we have to save up a little bit of money to get to a goal that we have for a particular property, we walk through a savings plan. And so here's what that kind of looks like. So if I'm having a conversation with a client and maybe they're currently paying $1,500 a month in rent, right? But after putting a budget together, we feel like, hey, we can reach $3,000 a month in housing expense, but we're just kind of lacking the savings for our home purchase. Here's what our plan should be then. At the first of the month, when we're paying our landlord for that rental of $1,500 a month, what I would encourage that client to do is start saving like you're actually making a $3,000 mortgage payment today. So when I transfer that money to my landlord for $1,500 on Venmo, I immediately go to my checking account and transfer $1,500 to my savings account. And when I do that, does a couple things. One is obviously we know it's going to create savings, right? So at the end of 6 months, maybe I've accumulated $9,000 in savings. At the end of the year, maybe it's a full $18,000 in savings, not including interest that could come from a high yield account. But I think more importantly, it also creates a discipline and a rhythm to making a mortgage payment, because as you've seen in our payment calculators, you're going to, as you explore homeownership, you're probably going to have to increase your outgoing expense to own a home. And I think creating a savings plan like that gives you those benefits of accumulating savings, but also getting into the habit of making that higher mortgage payment. Well, one of the things that's available across the country in markets is different assistance programs. We call those DPA programs. And in the state of Connecticut, there are HFAs, we call it the Housing Finance Agency, that can help kind of close the gap or variance in down payment for you. And so I wanted to spotlight the Connecticut HFA program. And that can be a resource for us in this path towards home ownership. And if you're not buying in Connecticut or in other parts of the country, there are similar programs available. We can talk about those offline as you're building your own home buying plan with us. But in the state of Connecticut, there's the Down Payment Assistance Program, or DAP, that provides up to $15,000 in assistance. And it's kind of deferred payment, so it's not repaid in the future. There's the Time to Own Assistance Program that provides up to $25,000 in assistance, and it's forgivable at 10% of the assistance per year. The HFA Advantage Program, which essentially is just like the conventional down payment of 3%. And then there are special incentives for first responders, teachers, and active military. And we have other programs within APM, like the Pathway DPA program, that's going to allow a client using an FHA program to get anywhere between 3.5% to 5% in assistance funds. And there's also Fannie Mae products that are available out there too as well, that are designed to support low to moderate income households in home ownership. Most of the programs available under the first-time buyer space are targeted towards low to moderate income households, which low-income housing is generally someone that makes less than 80% of the median income. Moderate income depends on what state we're speaking of, but usually it's somewhere between 100% of median income to as high as 150% of the median income. First-time buyer programs can be a really great resource for our clients to make homeownership just much more of a near-term goal. Some of us think we got to save for the next 3, 4, 5 years, but when we incorporate assistance programs, it really can make homeownership a near-term goal. And we love to kind of be able to look at those options for you during a consultation. Well, let's talk a little bit about the buying process as we're nearing the end of tonight's class. And we want to walk you through the 6 steps of home buying. So after tonight's class, You hopefully feel like you've gotten some great takeaways from our class. We want to kind of share with you what comes next, right? And we would encourage you to get connected with us for a free consultation that we do for our local communities across the country. And it's a 30-minute one-on-one session where I meet with each client one-on-one to design a home buying plan. And I'll give you some more details on that home buying plan a little bit later, but ultimately that output of that meeting is going to be to have us pre-approved for home financing. I don't expect to go out and run out and buy a house this weekend. It could be the end of this year, but ultimately the pre-approval provides the framework for eligibility, and it gains some agreement with us and the buyer of like, hey, this is what the roadmap looks like for us. The pre-approval is good for 60 days, but we can always recertify that pre-approval at any time. So that would be step one. And then step two would actually move us to home searching or the house hunting, right? Probably starts online. Maybe we're looking on Zillow or Redfin. Then we'd probably get connected with a local realtor that would help kind of aid our search, going from online to maybe looking at homes in person, maybe visiting a couple open houses. Well, as we do that house hunting, well, maybe we find the home that we love, right? And we decide to make an offer on that home. Well, once I make that offer on that home, now I have an agreement with the seller and I go into what we call as escrow for my home purchase. Usually from the time at which my offer is accepted with the seller to the time I get my keys, it's about 30 days in most parts of the country. When I move to step three, it does create some action items for myself as a buyer. And also us as a lender, because within 24 hours of that accepted offer, you get a call from me saying, hey, congratulations, you did it. Now you have an accepted offer. Let me explain to you a little bit more about what to expect next. And then we'll schedule you for a follow-up consultation to review all the details of your financing. Well, as a buyer, your next action item is to complete what we call an earnest money deposit. And usually that deposit is anywhere between 1% to 2% of your overall purchase price. It does count towards your total out-of-pocket expense. And so if I bought a $450,000 home, I would probably need an initial investment of $4,500. What that deposit does is it tells the seller that, hey, I'm interested in this property. I want to make things work. I have my financial investment made. And in most parts of the country, we have what we call as contingency periods as part of the contract, which allows you as a buyer to do your homework on the property, which includes getting the house appraised, getting some inspections done on your house, maybe doing a sewer inspection, maybe foundation, roof inspection, whatever you think you need to do to feel really comfortable in this big purchase you're going to make. And then we also get your loan approved as your lender, right? Now, within the process, there's things that occur like administrative things like verification of employment, verification of assets. Those all happen while we're in the escrow process. And as we look at interest rates, there's also a time at which we lock in the interest rates. Interest rates in the trading day move by the minute. So interest rates could start the day at 6.875, they could end the day at 7%, or they could go down to 6.75. It really just depends on what's going on economically. But once you're under contract with the seller, then we have a strategic conversation on when we lock in that interest rate. And those are things that are outputs of our consultation with you. At step four, again, we're doing the administrative functions. Then we move to step five, which essentially is finalizing your underwriting approval with an APM underwriter. That underwriter is reviewing your income, your assets, making sure the program is structured correctly. It also will take us almost to 3/4 of the way through the process. At that point, we're going to issue to you a final closing disclosure, which ultimately gives you a 3-day cooling off period before we get to the final milestone. Now, in lending, you will receive disclosures that are electronic disclosures that are e-signature. There's usually 3 different iterations of disclosures. There's an initial disclosure that goes out within 72 hours of step 3. There's another revised disclosure that goes out once you lock in your interest rate. And then finally, that closing disclosure that goes out at step 5. And after that cooling off period is elapsed, that brings us to the very final milestone. That's called closing the loan. That's one of the in-person things that we do have to do as buyers, aside from going out and see the house, right? That is usually done in person with an escrow officer, an attorney, public notary, depending on where you're at in the country with your home purchase. At that session, you're signing in-person documents. After the session is completed, you'll usually wire in your final deposit or funds owed for your transaction. Those monies get reconciled by the escrow team. And then they also get the contribution of your lending funds that we're doing and possibly any first-time buyer programs that you've elected. Those monies get all balanced out, and then documents get recorded with the county recorder's office. They're recordable legal documents. They usually record a grant deed that transfers ownership to you as well as the deed for the loan. The recording confirmations come in. We usually get looped into those email chains, and then we get a chance to give you the favorite call of the day, which is to tell you, congratulations, you're now the new homeowner, because once those confirmation comes in, it's all real. And you get a chance to start packing and moving into your new home. Best part of my day is when I get a chance to make those calls, because it's a huge accomplishment, right? This is going to be one of the biggest investments you decide to make. The fact that you're all taking time out of your busy Thursday nights to listen to home buying obviously shows me how serious you guys are about taking those next steps. Our relationship with clients doesn't stop after the loan closing. We have an aftercare program where we have a rate watch system that kind of monitors when the right time is to refinance a home. We have our HomeBot system that tells you a little bit more about what's going on with home market values in your area. And then we always do annual check-ins with our clients, because again, this is a relationship over time, because things change for our clients financially over time, and we want to make sure we're there as a resource. Well, if you're thinking about starting this path towards homeownership, I'd love to be able to get connected with you for one of our video consultations. It's a really simple 3-step process. Starts with an online application, which is a very intuitive application. It's only a soft credit check, like I mentioned earlier, so you don't have to worry about your score being impacted. You'll also be required to upload a few documents as it relates to income and asset proof. And then you'll use our scheduling system, which you can see here, to book your 30-minute session so we can get a chance together and build that home buying plan for you. Now, after tonight's class, you might just have some questions about interest rates, or maybe there's a credit scenario, or maybe you want to talk a little bit more about multi-unit properties. I would encourage you to schedule one of our introductory calls. We can hop on a call and just go through any questions that maybe you got missed or you didn't get a chance to answer or ask in tonight's scenario. And then when we think about a consultation, here's kind of what we cover. We're looking at, where do I want to buy? What's my housing budget look like? What are current interest rates that are applicable for me? How much should I expect to save for my home purchase? Are there some credit opportunities that I need to take a look at? We want to be a resource for you to make sure that you're properly prepared when it comes to home buying. And as I'm wrapping up tonight, I just want to point out one of our resources available to you on mobile. It's our APM mobile app. You can start the application process right there. You can follow kind of the progress of your loan via mobile. You can also use our calculator, which a lot of clients do. So if you're out at an open house on a Saturday at 12 o'clock, you can hop in our calculator, run some different payment calculations, and see if this home works for you. Just want to again spotlight our $750 closing cost discount as part of our UConn Alumni partnership. So that applies to purchases or refinances that will make sure that you get set up on your financing. And then, these classes that we teach, we're actually going to teach over 55 classes this year. They're available all across the country. So if you have friends, family, coworkers that you think you might benefit from a class like this, we'd love for them to participate in one of our upcoming classes throughout 2025. Also, you have 3 more classes for your alumni that'll be available to you. So encourage some of your fellow classmates to come check out what we're doing here. And as I wrap up, I just want to share with you my contact information. So if you do have any questions, don't hesitate to shoot me an email, text, call, and of course, you can book a consultation at any time. And we love what our clients say about our local communities. So we encourage you to check out what people are saying about, those that have just attended workshops. You can check out some of our reviews on Google and our various social platforms. We really take seriously our role in achieving homeownership for our buyers. So we love to put great resources out online for our clients and then share what experiences look like from fellow attendees of our workshop. So with that said, I got a few minutes before the top of the hour. I'll be here to answer questions as long as you need me here. I see some things already kind of going into the chat here, so I'm going to take on some questions and be here for you guys to answer any of these before we wrap up tonight. Okay, awesome. Okay, thanks for that. Okay, cool. We had a nice little comment in the chat. Someone that's actually a licensed real estate agent in the DMV area. That's awesome. We serve the DMV area, so we'd love to get connected with you after tonight's class. So thanks for that comment. Any questions from the audience? And we have a lot of us still hanging in there. I know I'm just in front of dinner time or maybe post dinner for you guys. So I appreciate everyone being attentive and sticking around here. right. Then I think we're good. I just hopefully that's a sign that we were super thorough in today's session. So thank you so much for spending time with us this evening. Oh, we got a question that came in. Does the USDA loan apply to purchasing or building a home? So the USDA loan, the standard program is built for new or existing properties. If you're trying to construct a home, there's a USDA direct program. I don't know if they have funding that would be directly through USDA. But if it's a resale or standard new home purchase, that's certainly something we can handle here at APM. All right. Thank you for that. I appreciate that. Okay.
All right.
All right.
Well,
Well, thank you again.
Jason,
Oh,
super
Josh,
big
you're
thanks for
back.
everything tonight. Yeah, I'm back.
Yeah, for sure. For
No, we
sure.
just want to thank you again for
Yeah.
joining us and partnering with us on this and providing this great resource to all of our constituents, no matter where they are. So, looking forward to the next one.
Yeah, me too. Yeah, it's been fun. It's really a pleasure to get a chance to connect with the community and provide these resources. So hopefully you get a chance to see everybody in the future. Yeah, look forward to the next class.
Absolutely. And like Jason said, we're going to get all this information out to you. There's actually a website that links right to the APM website as well for UConn grads to take advantage of. You can get that right off of the foundation.uconn.edu website, where you can get more information about our partnership with APM. But we'll also get this to your email that you used to sign up for this workshop, and we'll get that out to you tomorrow once we get everything buttoned up for you.
Sounds good.
All right. Well, thanks again, everybody, for joining us.
Absolutely.
Jason, to you and your team, thank you as always. And we'll see
Yep.
everybody next time.
All right. Enjoy the rest of your week, everyone. Good night.
Good night, all.